RIA. I travel around the country and deliver succession planning seminars, so I help advisors who are looking to buy a practice or sell a practice. So I want to introduce my esteemed colleagues here today. We've got Alexander Williams, Tom Scavata, and Michael Rowland. So if we can start out, I'll just have each one give a little background of yourself. Alex, do you want to start out?
Yes, good morning, everyone. Again, my name is Alexander Williams. I'm out of Connecticut. I'm a certified financial planner, a chartered life underwriter, and a chartered financial consultant. I've been at CFP since 1989, and I specialize in the mass affluent individuals. I have an office in Connecticut and also one in Georgia. And I'm really a financial planner. I help people discover what their goals and how to implement their goals.
Tom?
Thank you, Chris. Good afternoon, everybody. My name is Tom Scavata. I'm a financial advisor with UBS Wealth Management here in Midtown Manhattan. I've been in the industry for 20 years. And our business focus is working with nearing retirement age corporate executives, many private business owners and professionals as well. We host an ongoing series of educational workshops, in-person seminars, conference calls, webinars, and so on to provide education on a number of different financial planning topics to these individuals. And then the follow-up to that is the completion of a comprehensive financial plan, what we call our financial goals analysis. And many times what we're working with on these individuals is the recreation of a paycheck once they phase into retirement mode. So the completion of a financial plan and the construction of an investment portfolio, analysis of Social Security, pension benefits, and so on is a big part of what we do. And the next step, so specific to today's topic, we do implement a number of different strategies, one of which is an ETF model portfolio, which we base on the UBS House View, which is a monthly offering that we have within our firm from our wealth management research group that gives us broad asset allocation ideas, and then we implement that and design a portfolio. And we use satellite individual stock portfolios, laddered bonds, and other managed income strategies to supplement that to really help create a kind of a bucketed approach for our clients to satisfy income needs over their lifetime.
All right, Michael?
My name is Michael Pellman Rowland. I'm part of the Vector Group at Morgan Stanley. It's a team of 10 that manages a little over $1 billion collectively. We have many sort of areas of expertise, but the two areas that I specialize in is working with same-sex couples and those looking to incorporate socially responsible investing or impact investing into the way that they're managing their portfolios. Been in the business for 13 years, and we do incorporate ETFs into our strategy, so hopefully be able to lend some perspective into how that can be effective for you all.
Perfect. I know we're the last people to go before lunch, so we'll try to keep this short and sweet. Never want to go before lunch or go before drinks. So with that said, we'll get started. And you guys have all created successful businesses. But if you can think back to when you originally started, can you kind of give us an idea of one or two things that you may have done to really set yourself up to turn your practice into a business?
I'll start. Basically, what I've learned in the last recent years is that I do less talking than listening. So when I ask the right questions, the probing questions to make them feel that they're being heard is the key to my success. I can remember a referral client a few years back. She was a widow, and she was working with a previous firm, and she was referred to me by her CPA. And I remember the conversation we had with her. She said that she's very nervous about her retirement. She's spending about $30,000 a year for a psychiatrist, and she doesn't think she has enough money. After reviewing the facts, she had over $1.3 million. But after she left her advisor, she couldn't understand what he was saying. And she has to get a therapist to kind of analyze where she's at. So I thought from that point on, it's really important to listen to your client, ask probing questions, make sure they understand exactly the status they're in. So that's what I would say really helps, asking the questions rather than doing all the talking.
Good point. I was always taught to use your 2 ears and 1 mouth proportionally. So, Tom, what about you?
I think a big part of the success we've had in the business over years is it's very process driven. So early on in our career, in my career with our group, we were at Smith Barney. We were part of a much larger retirement planning group. But I think a big part of what we're able to impart upon people with our expertise is that we're consistent. We have a constant flow of information that we provide in our workshops. We follow that up with the financial plans, but often there's a long lead time between the initial dialogue and then a liquidity event that would in turn bring us to us as a client. So I think having consistency with that process and sticking to it, especially when you're dealing with seminars and presentations and things of that nature. So there may be a 5-year lead time between the first conversation and when someone becomes a client. So obviously sticking with it, having a prospecting database, if you will, is a big part of it. And then once we're working with those clients, the level of comfort that they have by the time that they do become our client has really gotten to a point where we're already well synced with them. So.
Michael, what about yourself?
Well, when you're on a team, which I hadn't been for the first 10 years of my career, it's a little bit harder, I think, to think of it as a business because you're sort of the jack of all trades and master of none. And once you get into a team environment, it gets a little bit easier to run it as a business because everybody can have very clearly defined roles. And I think what's critical is making sure that everybody understands what role they play and not sort of skirting the lines of those responsibilities and saying, well, I know my partner normally hands financial planning, but I'll do this plan just because you feel like it, and not sort of sticking with who wears what hat. And then being able to communicate that to the clients you're working with or the people in the organization who wears that role on a day-to-day basis, and you clearly define that on your website when you're communicating that to clients so they get this feeling like they're part of something that's dynamic and organized as opposed to this sort of haphazard taking things as they come sort of organization, which really will bleed through into the confidence that anybody you're working with will feel in whether or not they're working with a group that's organized. So you want to segment it into practice management, business development, and then basically anything else that falls outside of that, whether it be marketing events, networking within your firm, etc.
Okay, great. Next topic that we want to touch on is the robo-advisor. I know when robo-advisor first came out, many advisors feared that it was going to negatively impact their business. And one advisor that I help acquire a few practices with kind of gave me a great analogy. And if you think about the robo-advisor, kind of like Iron Man with Robert Downey Jr. and the Terminator, not Arnold Schwarzenegger, but the actual alien that he was going up against. At the end of the day, you're both doing the money management aspect of it, but you as the advisor can take off that shield and be Robert Downey Jr. You can be very empathetic and listen to your clients, similar to what you were saying about listening to what they say and understanding what they say. And it's really kind of taken away that robo state. Have you guys seen any kind of negative impact on your business, or are you guys implementing any technologies to embrace that segment of the client base?
No negative activity. It's really a positive swing. People are looking to go on computers and figure things out. They're accustomed to doing that. Even our marketing has got to be more social media driven. So I think it's a very important part of our practice to implement that and really encourage that for people to really sign up, to really find out what their risk tolerance is and what they're really looking to do. So I think it's a very important part of practices today.
I'd say it hasn't been had a big impact on our business. I think one of the key things with a robo-advisor strategy as the core strategy for someone that's at the life stage that we're dealing with is the behavioral finance component of it. Obviously, it's great to have that plan in place with automatic rebalancing, but it's very hard to stick to that in times like August of this year, 2011, 2008, and so on. So I haven't really seen the impact of that. I think that's probably going to be a bigger issue with some of the clients that we're going to deal with from maybe the generation behind the generation that we're dealing with now, the next generation of our clients. Within our firm being in a large wirehouse, I'm sure that's coming, some type of a robo-advisor platform that they bring on board what we're doing. I think what we're offering, managing ETFs in a portfolio, we're using the context of the house view, different thematic approaches we want to take in a portfolio to express a view, whether it's sector-driven, whether it's areas of the world with a currency hedge, as they were talking about in the previous panel, some of those topics may not be as, it's not as dynamic necessarily in a robo-advisor platform. I do think, to your point, that will start to migrate towards what we're doing. We do charge an advisory fee for our services, but again, there's a lot of advice beyond investing that goes along with that relationship. So maybe the robo-advisor software-driven portfolio management fits underneath that umbrella, but we certainly offer a lot more than just quarterly rebalancing on size and style ETFs. So that's my thought.
Yeah, I mean, I think he nailed it. Robo is going to continue to expand its presence within our industry, and in many ways, a lot of what most money manager programs, whether it be mutual fund wrap programs or ETF models or separately managed accounts, all have some robo component to them. So there's not that big of a difference. It really comes down, I think, particularly for millennial generation, about cost and transparency and not needing to have a conversation. The younger generation wants to text, they want to email, they don't really want to talk to people, they want to be empowered to learn, give them the information, let them disseminate it, and then they're going to decide on what they want to do or not. So I think the easiest way to try to eliminate the threat of the robo is to appreciate the difference in the way that generation wants to be communicated to, and arm them with that information so they can still, see the value of you versus, calling into the call center or having to scour the internet. And also then not having somebody during those downturns, because the robo model is very easy when everything is sort of calm and all good. But I can remember succinctly during '08 where I had certain clients that were with online brokerages. It took them 2-3 hours just to, get in touch with somebody. So robo will be powerful and will probably get more expansive, but it has its own, downfalls, and it's just educating people on what those are to help them appreciate whether or not it should be a full component of their portfolio, a small part, or, really, no consideration at all.
Great. Given the state of the world that we're in today, sooner or later they're going to raise interest rates. It may happen in December, it may not. And there's a number of different storm clouds that are on the horizon. What are you guys doing in your practice to help quell the fears of your clients and make sure that they're prepared in case there's a downturn?
Is there anyone here that could tell you when the downturn's going to happen? So we don't really know. We have to prepare for it. Like every 7 years or so, it seems like it's happening. So we're up to it right now. I think, as he said earlier, having constant communication with our client, we're available to answer their concerns or issues. We have to have safe money components in our practices, no question about it, for those people who have a risk tolerance. So we already have that in place. We just have to be able to release it when it's important time to release it. So maybe this year, maybe next year, or the following year, but it's going to happen pretty soon, I think.
I think a lot of it for us comes back to the financial planning aspect of it. What are we trying to achieve, right? And monitoring that plan over time. So if you're looking at the long-term goal for someone in their investment portfolio and assessing what their percentage of probability that they can achieve that goal, using Monte Carlo, for example, if you're constantly revisiting that plan in different periods of time in the markets, and then also, along with that, structuring a portfolio where you have maybe a liquidity bucket to absorb some of the downturn, maybe something that's a little bit more intermediate term, and then a longer term component of the portfolio, what we call goals-based wealth management. But I think using the financial plan to reassess where they stand after we go through some period of downturn in either the equity portfolios or what may or may not happen to fixed income over time, and then sort of putting it into the context of what does this mean for you going forward and what your goals are. Does it make a big impact if we sort of ride out the storm a bit? I think giving that kind of context helps people sort of withstand those periods a little bit better.
I think specifically to your point on interest rates, it's a topic of conversation. I feel like it's been around for at least a decade now. Is when is the bond bubble going to burst? And so far it hasn't happened. And given the slack in the economy and the pressure on rates globally and currency movements, it's feasible it could stay with us for some time. And so the question really becomes, what does the client need insofar as income? When is their liquidity needs going to kick in where they need to draw down some of the principal? But there are strategies you can implement, whether it be looking at floating rate notes, other vehicles that tend to be less interest rate sensitive, and even maybe coming up with more of a barbell approach where you have sort of long duration assets that are more interest sensitive but have higher coupons, and then give you a shorter duration asset like a floating rate note or some other component that has decent income but will offset some of the volatility on the duration side. So it's about having that conversation with the client, and then even maybe looking for other alternative income sources, whether it be dividend stocks, yield cos, MLPs, other things that can throw off a cash flow that will be less interest rate sensitive because they tend to raise those dividends over time. And you have to educate the client that the risk inherent in those vehicles will likely exhibit higher beta or higher standard deviation. But if it's a long duration asset, that will hopefully be less critical to the client, so long as they can handle the risk. So what's critical really is just having the communication with the client and helping them appreciate that since we don't have the crystal ball, what are the potential scenarios and what scenarios they would feel most comfortable sort of riding through, and then constructing it through that lens.
So it really comes down to the planning that you've done. So following the Benjamin Franklin aphorism of planning to fail, or failing to plan is a plan to fail.
Right.
Okay, fair enough. I grew up on the wholesale side of the business, owned a distribution company, and every wholesaler that I've ever met always talks about the statistics of the baby boom generation, 10,000 people retiring every day for the next 17 years. Talking about a little bit of the difficult interest rate environment that we're in, when is it going to go up, what have you. What are you trying to do right now to help your clients plan to make sure that they can meet their needs during the retirement years?
Okay. Well, you're right, because there's going to be a massive amount of people in the baby boomer generation who are looking for solutions now, and they're looking for guaranteed retirement income. People are going to retire for 30 years. So they have to have a plan, what they're going to do for the 30 years. The typical plan or the typical answer is, I'm going to stop working. But what are you going to do in between then? You're going to stop working for 30 years? I mean, what are you going to do during that time period? It's very, very important. So having that discussion with the prospect, having a plan of action, what they're going to do through those years, is very, very important. I think that a major part of my practice is dealing with the baby boomers, retirement solutions, income solutions, investment analysis, retirement planning. So that's something that we're taking up to another level, and having more holistic planning for those clients. So I think that's kind of important right now.
Tom, what are you doing with that?
I think it's sort of touches on what I said earlier. I don't want to repeat myself. I think the big difference now than maybe compared to 20 years ago, when it came to generating income in an investment portfolio, you could ladder a portfolio of fixed income instruments, whether it was at one period of time their CDs, some government issues, and even corporate bonds to generate the necessary cash flow, then have your equities as the inflation hedge. Well, obviously those days have passed us, and I think using the plan, as I said, and creating different buckets of the portfolio, if you look at longer term return assumptions, if you rely on something like the CAPE ratio, what does that say about equity returns? It's probably mid-single digits. Fixed income assets on a total return basis, even factoring in some of the shorter duration instruments, maybe it's a 2 or 3% on a total return basis. So how do you use the different instruments available to you to create cash flow? You clearly can't just clip all of the coupons and dividends to satisfy that cash flow. So having multiple buckets to satisfy their income needs and replenishing those buckets over time is important. I also think that a lot of our clients, as part of the financial planning process, maybe the discussion is you may want to work longer to get yourself closer to obviously 66 to get the full Social Security benefit. More and more folks now, compared to 20 years ago, are talking about stretching it out to 70 to get the max benefit. And you may want to have other sources of income. And for those folks that are lucky enough to have defined benefit pension plans, that helps. But you need to recreate what is lost from that defined benefit pension plan. But I think planning has a lot to do with it, and then working with the current investment climate and realistic assumptions on returns. And also modeling in needs that will be outflow for them, whether it's a long-term care event, healthcare costs in general, the supplemental healthcare that they'll have above and beyond Medicare, segregating that out beyond their normal fixed expenses and helping them get a feel for that, whether there's the additional monies, discretionary spending for vacation and lifestyle events, or whether it's going to be for a healthcare event. Sometimes when you segregate out those types of costs, it gives somebody better comfort on how they're going to actually go about satisfying their income needs.
Yeah, I'd say two things. One is, the progress that's been made in the annuity world has actually been really interesting for the purposes of income, because for a lot of folks that are in that retirement red zone where maybe they've got 5 or 10 years before they're planning on retiring. They want to keep some, or maybe they need to keep exposure to the market, but they're worried about losing their principal. There are some really interesting developments in that space that are giving people the ability to keep exposure to the market, but have guarantees in place so that they're ratcheting up every year, and then they can keep that income and have that supplemental, sort of defined benefit type Social Security check as an offset, whether that's in their qualified account or not. The second point I would make is really talking to the baby boomer generation about where they're at with their kids, because many parents right now are seeing that their kids are back home living with them, weren't expecting to see that expense on the line items. So depending on how wealthy or not the client is, sort of baking that into the assumptions of how much additional cost am I going to have on a monthly basis, not just for my own life, but how am I going to, have my 30-year-old kid who's still on the couch, supplementing his income. Maybe he can get out into the world, so I don't have to deal with him anymore. So, these are some of the real concerns that are a result of sort of these tough economic times where it's, just really hard right now for a lot of the younger kids in this country to get jobs, and the impact that has on the financial planning, which isn't in the traditional model. So whether that's a special line item in the financial planning as an anticipated cost or some other consideration that needs to be looked at to plan for that extra cost, because it's considerable. And it's a dangerous thing, because the longer they stay out of work, the harder it is to get back in. And so for some families, I've heard this story, they've got 2 kids under their roof in their 40s, and they don't really know what to do about it. And that's tough to plan for. So if you're in the planning business, or people who are in a similar situation, it's critical that they think about the impact of that from a longevity standpoint, up and above the nicety of having family under your roof and maybe being able to take care of you in your old age. There's some real financial downside to that reality for a lot of families.
Just touching on Michael's point, we've had 2 clients just this year that had to move their home and outfit a new home to house their 90-year-old parents in one case, and their 2 kids in their 20s, to make sure that this home had the space and availability for everybody. So it's something they never had thought about for their own retirement, but they're in that kind of sandwich generation that people are talking about. We're actually starting to see some evidence of that. Yeah.
Interesting. Next question I have is, there are a lot of different ways to be involved in our business. You could be a solo practitioner, you could be a team, you could be a hybrid advisor, part broker-dealer, part RIA, you could be fee only. And we actually have 3 guys that have come from different backgrounds. And Michael, actually start with you, because you've gone from a solo practitioner to a team environment. What was kind of the genesis of that? What was your thought behind why you went to the team approach? And then I'll turn it over to Tom, who's always been on the team side of things, really some of the pros and cons, and then love to finish up with you, Alex, on being a solo practitioner. Have you ever considered going that route?
So really the nexus of looking to join a team was, you get to a point as a solo practitioner where you start to sort of, bump your head up against, the scale at which you can sort of expand your services and still manage your business on a regular basis. And so, one of the alluring, I'd say, traits of the business to begin with, which got me into it, was the fact that you are a solo practitioner. You can kind of make your own hours. You can decide which clients you want. There's a lot of autonomy there. But that also becomes a burden as well when you can't delegate to other people on your team responsibilities, and just having somebody else to bounce ideas off of. And my practice has meaningfully expanded in the time that I've joined a team because of those factors. So for me, now having been on the other side and being in a team, granted, it's like a marriage. It has to be the right team. You got to find the right partners, because if it's a bad fit, it'll make your life more miserable. But finding the right team is really, in my opinion, going forward, the only way to go, as wealthier clients are looking for that sort of private family office type of a feel, where you're not exactly walking their dog and paying their checks, but you're giving them this very well-balanced brain trust with multiple perspectives, so they can have all their assets in one place without needing to diversify into different firms. And from what I've seen, my ability to attract and acquire that ultra high net worth segment has meaningfully improved in the time that I've expanded, my structure with having, teammates to help win those assets.
I give an interesting perspective on this. When I came into the industry originally, I was hired as kind of a marketing associate support person, and then over the years brought in as a junior partner. And my senior partner, who unfortunately passed away in October of 2014, was an excellent mentor for me, and we sort of grew the practice together, really, with his leadership. And after his passing, I've kind of now stepped into that senior role. We brought our junior person up to sort of get into a junior producer role as well. And we're in a transition phase where we're going to grow the team back out to at least 3 or 4. So I'm sort of seeing what it's like now to be the lead producer with just one support person. I really do see the value in the team, and I look forward to the point when he can really get into that role and then bring a support person in. So I've seen both sides of it. And he really, one of the topics that Michael touched on before, having defined responsibilities within the team does make a big difference. My junior partner now is very much focused on the construction, the completion of the financial plans. Obviously, I have to keep my eye on the portfolio management. But then having another person on the team that's really dedicated to the client service side of what we do is very important. So I've sort of seen both sides of it, being in a bigger team for many years, a short period of time here where I'm acting almost as a sole practitioner, and then getting back to that, I can really see the value in teaming.
Next year, I see the implementation of the Year of the Fiduciary. We all heard about the Department of Labor working along with the government to make sure to enforce that fiduciary responsibility. Working with a team, which I've always seemed to work with a team either through my association, Financial Planning Association, or colleagues that I know from the CFP board. And working as a team really helps that process, because it's very important to always act in the best interest of the client. We've always been doing that. We say that, but we're going to be challenged with that concept next year, because you're going to have a lot of clients who are going to question how, when the market starts to tank a little bit or things don't go the way they plan, they're going to question the fiduciary standard of the advisor. So I think working with a team, either someone from your firm or a colleague, is very healthy in your practice. It's very important to make sure you can bounce different ideas off professionals and maybe have a collaboration as to what's best for that particular client. And having the educational component is very important. It's important to educate the client the solutions you're trying to implement.
Okay, great. Last question that we'll ask before we open it up for questions.
I thought that was the last question you said.
We keep going.
Okay.
Given that we're in a global world, and we've had a number of great speakers earlier today talking about different countries, different locations and sectors to invest, when it comes to ETFs, and I know it seems like on a daily basis that new funds are coming out and people are figuring out ways of gathering assets, how do you guys go about looking at the universe of ETFs and when and where to implement them?
Well, ETF is the best thing of the future. You really have to be in part of that and make sure your client understands there's all the different options that are available. So yes, it's a very important part of my practice to make sure that we explain that to clients and let them know these are options that are low cost. But the last 6 months or no, the market has corrected a little bit. So we have to keep communication with them to let them know how things are going and what their goals have to be revised to make sure they meet their accomplishment or their goals. So I think it's very important to have that component in your practice.
As I touched on earlier, the construction of our ETF portfolio is really based on the house view from UBS Research, which is really wealth management focused, which we like, as opposed to being more institutionally driven. And I think it gives us a big picture view of the world. But what we like about the body of work that we're looking at when we're constructing the portfolio is that there's certain themes that you want to look at. So to just have an actively managed ETF portfolio that's purely size and style without specific favoring or overweights in certain areas, I think you're really adding your value when you do that. And what we're striving to do is have a better risk-adjusted rate of return than a global index, let's say MSCI All Country World. And one of the things that we'll do above and beyond looking at just the research about sectors and asset allocation and whether we want to have a currency hedge in place or certain sectors within the U.S. economy, we have an excellent ETF strategist, a specific research analyst for ETFs, David Perlman at UBS, who then provides reports for implementation ideas based on what the research group is looking at. And we assess that, run the portfolio, and then we'll have a third-party outside firm that will actually come and do some risk analytics on the portfolio just to see how that stacks up versus the index we're competing against. So I think relying on global research and then picking which one of the many ETFs that are available to you, if you're going to have minimum volatility in the emerging markets, if that makes sense for the type of clients that we have, is the way that you can then use ETFs and put your own touch on it, if you will.
Yeah, ETFs have been very important and powerful for us. We run primarily discretionary portfolios that are individual stock-based. However, what ETFs serve for us in its power is their ability to give us exposure to certain areas or themes that we couldn't get through individual stocks. So if it's a country theme, if there's a sector theme, even if there's a currency theme or we want to get access to a country and we're worried about the currency exposure, there are all these vehicles now that give us that ability to enact that very quickly. And the liquidity component is really critical. As I'm sure most of you know, it's you're making sure that the ETF that you're in, you can get out of. And get out of during difficult times, because there's a good example that we like to highlight, which was back in 2011 when the tsunami in Japan hit. We had exposure to Japan, and we were able to huddle up that morning, make a decision, sell Japan at the open, and move into South Korea. And because of that, escaped a lot of the damage, and we're able to do it very quickly. And so having that liquidity is really paramount. So it's critical to not only leverage ETFs for these specific themes or outcomes that you're looking for, but making sure that the liquidity and the management is effective, so that you can get out at a reasonable price. Because actually, as we saw at the end of the summer in August, there were a lot of ETFs that had some trouble tracking their benchmarks because their liquidity wasn't sufficient. So it's critical to not only look at the fees and the performance, but also how active the trading is, because you never want to go into a ETF that trades by appointment, because when you want to get out, the doctor might not be available.
Great. Any questions for our panelists? I think we're all ready for lunch. Thank you guys so much.
Thank you.